Let's continue on with building our assumptions. We want to value this company. We've come up with the risk-free rate, 0.7%. We've come up with our expected return on stocks. We said that's going to be 7.5%. It gives us a market risk premium, 7.5% minus the 0.7% of 6.8%. So now we need a beta. So I'm going to add some rows. We can put beta in there. We're talking again about Walmart. And so in talking about Walmart, what kind of company is this? So let's start off step one. Remember the revenue sensitivity. This is definitely a defensive company. I don't think there's any doubt. Walmart was one of the few stocks that actually had a positive return in 2008 during that financial crisis. This year, they've done extremely well earnings-wise during the COVID-19. They were selling staples, and people were buying staples, not just toilet paper, but all kinds of canned goods and food. People were stocking up. People who used to eat out at restaurants, which is a more cyclical type of business, were instead buying food at Walmart. Walmart saw a big jump in their revenues. So definitely a defensive company. They've proven themselves in the previous two market cycles. So we'll talk more about it in class and give you some idea of what this would be. So Walmart is a grocery store, but they're also a department store. They're also the discount store. So they do sell more expensive things like TVs and computers and clothing. So I would not consider Walmart to be as low a beta, say, as a grocery store, even though grocery is a big part of their business. But so grocery stores I usually put in the 0.5 to 0.7 range. So this I'm going to say that they're in the 0.7 to 0.9 range. I would say definitely below 1. I don't think there's any question anybody in Wall Street would view Walmart as an above 1 beta stock. The second thing we talked about is their operating leverage and their financial leverage. So operating leverage, what we're talking about here is fixed costs. I'm going to say I assume it is low, given the very stable margins, gross margins. Discount stores tend to have very, very stable gross margins. When the prices of their inputs go up, they increase their prices of their goods, and that usually doesn't harm them too much. It's true if banana prices go up, Walmart will raise its price of bananas. So if they have to buy bananas at a higher price, they'll definitely raise the price for bananas and keep a pretty constant margin. That may mean people will buy fewer bananas, but they'll probably substitute it buying more apples, and Walmart will continue to have the same, very similar gross margin. And I'm going to assume low fixed costs, given the hourly non-union workforce. So that's my assumption. So that this is probably a firm with very, very stable margins. But remember the spreadsheet I gave you? So here I found Walmart, and in finding Walmart, here's their gross margin and net margin standard deviations. So I'm going to go back to this spreadsheet so I can put it all together, add a few more lines in here so I can get all this in here. And so let's bring that over. So and we see Walmart standard deviation of their gross and net margins. You can see this is a very stable firm. Very stable gross margins, very stable net margins. Now, on your company, you don't necessarily need to show the gross margin. I do think it's interesting to show what the standard deviation of the gross margin is. that gets back to that elasticity of demand. Is this a firm that when its cost of goods sold rises, it can increase its prices without losing losing customers? So very, very inelastic demand, or is this a high elastic demand such that they increase their prices 5%, their volumes fall 10, 15%? Well, a firm with very stable gross margins probably has pricing power, probably can raise and lower its prices with the cost of its inputs without affecting its margins. So its cost of goods sold go up 10%, they raise their prices 10%, and their margins stay very stable. And then the net margin, even more stable. They rank in the top 1%, very, very stable net margins. And so on operating leverage, I'm going to say, the table supports this. And so we're still on that low beta, somewhere in that 0.7 to 0.9, might even lower it below 0.9, maybe to 0.7 to 0.85 or something like that. And then financial leverage, that's the most straightforward one of all, because we just go and get it from the table. So here it is. This is their debt to equity. And what we'll notice very quickly is that their debt's slightly higher. It still ranks in the top 50%, but it doesn't rank as high as the gross margin. It's still low, so below average debt. So their debt to equity is 52% versus the stock market is 72%. And so yeah, their debt is below average, and since their debt's below average, I'm going to say this is going to push me. So this with the operating leverage pushes me to the lower end of the range. So my range was 0.7 to 0.9. Now I'm more in the 0.7, 0.8. So I'm not even in that 0.9 range. And then the last thing is we look at history. So we've got the history chart here. I'll bring it up so we can see it. You can see, and again, remember on this, my median is not the entire period. It's from like 1985. So it's a little skewed because Walmart was a smaller company back then. You would expect their betas to be higher. They're a very large company today. You can see the last several years, the last two crises in particular, their betas have actually been below 0.2. Their median for the whole period is 0.8, but the last few years their beta has been really, really, really low. I don't like using a beta that low for a firm like Walmart, but so it suggests well below 1, median of 0.8, but recent much closer to 0.2 to 0.4. So that's even below what you would expect for a grocery store. So I don't believe that about Walmart. I think we've been in a very unusual period of time where if you weren't a bank or an energy company, your betas just looked unusually low, and I think that's true for Walmart. I think going forward, coming out of this period, I just don't see them being that low. The 0.8 historical seems a little high, and so what you have to do is somehow bring all this together, and in bringing all this together, it becomes very, very subjective, no question. So final answer, I'm going to say 0.75. I'm going to put it below the median with a test range. Remember, we're going to do the data table, a test range of say 0.55 to 0.90. We'll do a wide range like that. So there's my beta. So I got my beta. What does that mean for my discount rate? So when you get your discount rate, KE, Our base case is going to be, remember this is the risk-free rate plus beta times the market risk premium. So we go up and we do equal and go find that risk-free rate plus our beta. Our beta is 0.75. I didn't put it here in the, so I need to actually have a place for beta. So let me add that in. So my beta is going to be 0.75. All right, so my final KE is plus the risk-free rate, 0.7, plus beta times the market risk premium. And that gives me a discount rate for Walmart of just 5.8%. That seems low, but that is what we're seeing in this market with the 10-year Treasury being so low. Because the 10-year Treasury is so low, that's going to give me an unusually high market risk premium, which greatly benefits firms with low betas, and it penalizes firms with high betas. So in Walmart's case, because they're a low beta firm, they're going to benefit from the fact that so much of the stock expected return is in that market risk premium because the interest rates are so low. All right, so there's our first number. The discount rate, 5.8%. So now what we'll do, we'll get into the growth rate. So think about with your firm, what are the drivers of that growth? So with Walmart, it's build more stores, but they are getting saturated in the U.S. It actually amazes me how close Walmarts are in San Antonio, some within just a couple of miles of each other. Pretty amazing to me. So I think there's limited growth in the U.S. They have tried some of these smaller footprints, something that Target has been very successful with. Obviously, Family Dollar and Dollar General have been very successful with. I've seen a few of these smaller Walmarts, neighborhood stores. I don't think they're doing very well with those. I haven't seen too many statistics. I'm not sure why Target has done very well and Walmart's struggling with that, but it's something that is definitely a struggle. But even then, there's just from where I live, there's several Walmarts just very close. I could ride my bike to several of them, and it wouldn't be that long of a bike ride. So getting saturated. You do have overseas. Now with overseas, they're doing very well in Latin America, really struggling in Europe. They bought Flipkart in India. That doesn't seem to be going very well. They're struggling to get a foothold in India or China or anywhere in Asia. Not sure what they're doing in Africa, but they have had great success in Latin America, but that's been a challenge. If you look at, just looking from that standpoint, is building more stores and going overseas, is there an online growth story for Walmart? Maybe, maybe not. They bought Jet.com a few years ago. I'm not sure how that's going. I have to admit, I've never bought anything on Walmart.com. I've gone to Walmart and I do shop there, but I just by habit go to Amazon. But I know both Walmart and HEB are doing this online grocery shopping. Either whether it's pickup or delivery, and maybe there's some growth there for the online side. I think that's probably more than anything going to cannibalize their existing sales. So instead of people coming into stores, they'll order online, but at least might help prop up their sales. But anyway, you just think through those kind of things. The demographics, here you just have to ask, where is the growth? So slow growth in developed countries, high growth still in developing countries, especially Latin America. So that is a benefit that Walmart has done so well in Latin America, Central America. I go to Costa Rica, and it's amazing to me how dominant Walmart is becoming. It's almost kind of sad to see Walmart buying out almost every major retailer in Central America and South America, and they have had great success, and those are faster growing areas of the world than the U.S. But their their growth rates, population growth rates, are slowing down as well, just not as dramatically as Europe and Japan and China and the U.S. So maybe there's some story there, but I don't think it's a really strong story. What markets are they in? Again, expanding overseas. New uses for existing products, the home delivery and some of these type of things are interesting. Walmart's try to get in other businesses like banking. There is maybe a healthcare story for that. I think Costco has been pretty successful in using its store space for dental offices or medical screening type of offices. So there may be something there. It'd be interesting. Disruptive innovations, obviously there. We're talking about Amazon and some of these new big players that we're seeing in China. The online presence, those type of things. I think there's certainly some issues there for Walmart. The box store where you go to the retail outlet and walk into a store is maybe COVID-19 especially might be reducing that as a growth story, and the growth will now be all shifting to online and even home delivery. So you can go through these others, Porter's 5 forces. That I don't think the retail area is a strong, attractive industry just because the competition is so strong. Walmart is very large and they're a big player, and it gives them some pricing power with suppliers. As far as economic moats, I think it's a sustainable competitive advantage for Walmart is that their operations are so well put together. They're very streamlined. They do have some cost advantages. Gives them advantages over other retailers, although Costco is a very strong competitor in that area. And then just market share, I think it's going to be a pretty intense competition between Amazon and Walmart, with some other players coming in, and who knows what disruptors will be there. So it's interesting. So I don't consider Walmart to be a high growth story, even though they're doing well with the COVID-19. I think this is an industry that's saturated, extremely competitive, very tough, other than Latin America, getting a foothold overseas. So that's kind of tough. So, if we think the economy is going to grow, remember we had the economy growing about 5%. So if we think the economy is growing about 5%, I'm going to say slightly slower growth in economy. So I'm going to put them probably in the 3 to 5% growth rate. I think they'll do a little bit better than inflation. That's why I give them the 3%. I don't think 5% is a pretty hefty growth rate, and firms have been struggling. But let's look at their historical growth. So if you're doing a firm, hopefully that one of your teammates did for the first project, you have this database, this print page 1, and you can look at Walmart's growth rates. And they look pathetic. If you go back to 2010, you could definitely put in extra periods of time. So if you wanted to look at the last 3 years, remember the formula for this is you do equal, open parentheses, you do the ending number. Let's do earnings. We'll do EBITDA. The ending number divided by the beginning number. So 3-year growth rate, you have 1 year, 2 year, 3 year, and then you have the beginning year. So you actually go back 4 years. Close parentheses, shift 6 to raise it to the power of 1 divided by 3 minus 1. We'll talk about this in class. That's what the compound annual growth rate is. So there's 4 years here, 1, 2, 3, 4, but there's only 3 growth periods. You grow from 16 to 17, 17 to 18, 18 to 19. So you got a beginning year and then the 3 growth periods, and you raise it to 1/3 minus 1. When you look at that, the recent growth has actually been slightly negative. So history doesn't bode well. Now, I don't know if I'll update this for 2020. We'll see. But recent very slow growth due to we can call it the Amazon effect, as we call it in the first paper. If it's a tough competitive environment. So you might say that, wow, how do you get the 3 to 5% where they've had negative growth the last few years? We can look at their net income growth, obviously, and see if there's any growth there. It doesn't look like much, does it? Their net income has grown 0.7% last 3 years. You could certainly try the last 5 years. Do it to the 1/5. That's negative again. So anything you do, and this is just the battle they're having with Amazon right now. They're willing to give up in earnings in order to maintain that market share. So I'm going to have to make a strong argument. I'm not going to use a negative growth rate with them, but someone can certainly make that argument. The other growth rates, sustainable growth, and the PEG ratio. The sustainable growth, the focus is on turnover and margin. So when you go back to your company's charts, remember those charts that we did, you might want to just look at asset turnover. You can see how flat that's been for Walmart. Just no growth at all. And then look at their net margins. Their net margins are down. So, from that standpoint, we can say flat turnover and the declining margins. Now, the declining margins might be an issue of them moving more and more to grocery, which have thinner margins. So that could be part of it. It's a more stable business. So it reduces their beta, and so that helps them with the valuation, but it does harm their margins. The other way, the very specific sustainable growth formula is that sustainable growth should equal your return on equity times 1 minus your payout. The argument here is, and we'll talk some about this in class, is a firm should be able to grow with its return on equity. Or the focus on return on equity is turnover and margin, so you want that to be the reason. Remember from paper 1, we want return on equity going up because turnover and margins are going up, not because debt is going up. But a firm limits its growth if it pays out too much of its earnings. And so we can actually get these numbers from Yahoo Finance. So if we go to Yahoo Finance, we can just type in Walmart. And if you look at statistics, in the statistics, they'll give you a return on equity. You have to go down and just find it. So here's their return on equity. It's under management effectiveness. Their return on equity is 20.63%. Let me add a few rows here. So their ROE is 20.63%. 20.63, and then their payout ratio So here it is under dividends and splits. Their payout ratio, they're paying out over half of their earnings, 50.76%. And so that gives us a sustainable growth. If you just take the ROE times 1 minus the payout ratio, and that gives you a sustainable growth of 10.16%. I like to use this as an input for short-term growth. I don't like to use it for long-term growth. There's no way Walmart's going to grow at 10%, but you can see that the market has gotten much more excited about Walmart, even though the growth rate historically has been very, very weak. The market's more excited about them here recently. So there's a number we can use. I think that's a little high for Walmart, but it's possible. The next one's the PEG ratio approach. And what this says is the PEG ratio takes the PE ratio of a firm divided by expected growth the next 5 years. What that means is if you take the PE ratio divided by the PEG ratio, you end up with expected 5-year growth. Now this is what analysts believe, but it does give you a number that you can use as an input for short-term growth. So let's get the PEG ratio. And let's get the forward PE ratio. We don't want the current PE ratio, we want the forward one, which is the PE ratio divided by earnings in the future. So we can get both of these numbers there on Walmart's site. So up here at the top, you see up here, here's the PEG ratio, 5-year expected growth. It's 4.03. That's actually a really high PEG ratio. 4.03. We usually think of a 4 PEG ratio as associated with high growth tech companies. So it looks like Wall Street is, at the time I did these analysis, Wall Street is really excited about Walmart. The forward PE is 23.75. It may sound high, but it's really not that high for a low beta stock like Walmart. So that gives us expected growth. We just take the PE ratio, divide it by the PEG ratio, and you'll notice that you get, it's not 589%. So if you like, you can divide it by 100 and convert it to a percent, because it's actually comes out as a percent. So if you want to divide it by 100. So when they do the PEG ratio, they don't do 23.75 PE ratio divided by 0.0589. They convert the expected growth into an integer of 5.89 without the percentage sign, without the decimals. And so the growth rate's actually 5.89%. So you have to divide by 100. So you can see the market gives you a lower number than what the sustainable growth says. I think this 5.89 makes more sense. I'm going to assume a short-term growth of, I'm going to say 0.07. You have to have, or 7%. You have to have some rationale for that. I'm going to say this reflects the continued shutdown economy that Walmart is definitely benefiting from, and I think they came out of some weak period competing with Amazon, but right now people are definitely using Walmart, but that's how long that's going to last. And so the time period, I don't give them much time for this, so maybe this extends for another 4 years. And so if you do that, let me add another row. I'll just be adding rows as I need. That gets you an H, which is just that time period divided by 2. So my long-term growth rate is going to be 3 to 5%. I'm going to actually, let me put this, the long-term growth. I'm going to put 0.04. I'll just take that midpoint, 4%. That's an important input. Well, short-term growth of 7% and an H of 2, that's going to take us 4 years to get from 7% to 4%, which gives me an H. Remember, H is just 1/2 of that period of time. So I've got all of these numbers in there, and they're all ready to go. Then we need dividend 0. If we go back to Walmart, you can just go back to the summary page for Walmart, and they will give you dividend 0. Their dividend, now they say this is the forward dividend. I really don't like this. We actually want dividend 0, which is the dividend they paid the last 12 months. So the best way to do that is hit historical prices. And when you do historical prices, you go back in time, you'll see the dividend. There's a dividend for 54 cents. You want the last 4, because they pay them quarterly. 54 cents, 53, so 54, 54, 53, 53. So for Walmart, their dividend is going to be 0.54 plus 0.54 plus 0.53 plus 0.53. That's dividend 0, 214. Now if you compare that to what we saw on the summary page, you'll see very quickly what they're doing on that summary page. You can see here they use 216. How did they get the 216? What they do is the last dividend was 54 cents. They just take the last dividend and multiply by 4. That's really a nonsensical number. The number you want is the actual dividends they paid over the last year. So you just add up all the dividends they paid the last year. Now if you did this with a firm like Google, it would be 0 because they don't pay dividends. All right, so we've got all of our assumptions now. All we got to do now is plug these assumptions into the model. And so we're going to do that, and we're going to the data table. I'll put that into the next video because this video is going long, but we're almost to the end here of being able to do the second project. Wow, that really was a long video. Sorry about that.